Good morning, everybody, and welcome to Wise Tech for Wise Money. I'm Gary Wayne, founder of A1 Solutions. At A1 Solutions, we work with financial service businesses, family offices, and market participants to improve efficiency, scale intelligently, and grow through smarter use of technology, systems, and AI-driven automation. Today's title is The Future of Wealth Management, AI Risk Control, and the End of Passive Investing. Today's conversation is a really interesting one. We're going to get into AI-driven investing, portfolio automation, and whether this type of model can actually challenge traditional wealth managers and even hedge funds. Joining me is David Sinclair, entrepreneur and operator behind a platform that combines family office services, wealth management, and an AI-driven investment system. Hi David, good to talk to you again. Welcome to the show. Hope you're having a good day and I hope you're okay.
Thank you for having me, Gary.
Before we get into the AI side, David, give us a quick background on yourself, how you got to where you are today, and how you actually got to this AI platform.
So, my background actually is in tech. So I spent 30 years as a serial entrepreneur in the tech industry, sometime opening up businesses in new countries for, large corporate players like Hewlett-Packard and others, sometimes opening up my own businesses. And I've done that for about the last 30 years in countries all over the world. Moved back to the States in 2019, actually started a privacy-focused mobile operator in the US in 2019 and exited that back in 2024. When I did my most recent exit, I said, I've had exits off and on over the years. Sometimes things have gone very well after the exit. Sometimes things have gone not so well after the exit. This time I'm going to do it right. And I began looking at what does doing it right look like, and really learned a lot more about family offices. And at that point, I looked at the options for setting up a family office and really wasn't happy with the options I saw. Everybody wanted to charge me an arm and a leg to set up and run my family office for me. If I talked to Goldman Sachs or JP Morgan or really Crescent Capital, anybody, they wanted to charge me a ton of money, and then they wanted to just subcontract out the work and have me pay those subcontractors on top of what I was paying them. And so I began looking at alternatives, and I decided to start my own business, actually setting up and running family offices for others. So I set up my own family office and then leveraged those resources to then go and provide family office services to others. And so that's really how I got into this. We began by focusing very much on family office services outside of wealth management. So, setting up legal entities, doing asset protection, doing tax planning, estate planning, family governance, those sorts of things, concierge services, property management, etc. Primarily because I was looking for a differentiated way to do wealth management. I didn't, want to just be another financial advisor charging, 85 basis points or whatever for picking stocks for clients, right? And through that process, we got engaged with a variety of people, and eventually we landed with the guy who's today our chief investment officer, Jacob Piccini, who has a background in specifically doing data-driven investment management. He's run hedge funds, he's run 40 Act mutual funds, and he's built mathematical models. And thanks to compute power improving so much and AI capabilities improving so much in the last few years, he's been able to migrate those mathematical models he's been using for 15 plus years to do investments to now developing an AI-driven investment management tool. And
Cool.
so that's really what we've brought to market today. We call that Darman AI. So the name of the group is called the Darman Group. And we've developed Darman AI as that tool, and Darman Wealth Management uses the Darman AI tool to manage our clients' investments.
You mentioned in our previous conversation that you effectively built three businesses. Can you sort of just break those down?
You're talking about the Darman businesses?
I think you mentioned in a conversation that you built three businesses. Is it part of the Diamond Group or?
I've built a lot of businesses over the last 30 years. I helped set up DHL's operations in Central Asia back in the 1990s after the collapse of the Soviet Union. I ran a mobile operator in Russia. I was the finance director for a mobile operator in Russia for a while. I set up and built HP's systems integration outsourcing business in 10 countries in Eastern Europe and Central Asia. I then left HP and actually started my own company doing industrial automation based on IoT in the Central Asia and the Middle East, and sold that business in 2019. And then the mobile operator business that I built here in the U.S. That I mentioned, the privacy-focused mobile operator business that I built and exited a couple years ago. So I've done this for a number of times, and then now I've got the Darman business.
So coming back to Darwin, I mean, what was you seeing in the market that made you think, this needs to be done differently?
In terms of the family office piece, as I mentioned, you go to somebody like a Crescent Capital or JP Morgan, they're going to charge you $250,000 a year to set up and run your family office, and then they're going to subcontract a dozen people to go and do that work, and you're going to end up paying twice, both them for administering it and then pay the subcontractors. And when you have all these subcontractors, they're not talking to each other. And so you end up, even though you're paying somebody to administer your family office, you end up being the hub stuck between all these experts, the CPA, the financial advisor, the lawyer, et cetera, and you're stuck trying to translate things. And so that's what really led us to build the Darman Group as a outsourced family office service provider, where all of our resources are in-house, all of our CPAs, all of our lawyers, all of our financial advisors, et cetera, et cetera. And so we get all those resources in the room and give the clients a single opinion, a single point of view, and really act as the hub for them, right? When we look at the wealth management space, when you talk to most people in wealth management and they start talking about family office, really what they're talking about is they want to get assets under management, right? And what are they doing generally? You talk to a financial advisor, he'll pick your investments, and maybe he'll contact you once every 6 months or once a quarter. If you're lucky, he's rebalancing your portfolio once a quarter or once every 6 months. It's really kind of a fix it and forget it industry, where they take your money, they stick it into some ETFs and mutual funds and stocks, and they leave it there. And they make their, whether that's 85 basis points or, we've heard numbers as high as 2% management fees. I got a client right now who's leaving JP Morgan Chase. He's getting charged 1.25%. He's got a fairly large portfolio, millions of dollars there, but they're charging him 1.25%. And what are they doing for him? They're putting him into a traditional standard 40-60 stock bond mix and just fix it and forget it, leaving it alone. And he's generating 6 to 8% growth a year, and JPM thinks that's great. And that's not really what the client's looking for. The client's much more aggressive and looking for something. And so, this attitude of very passively managing portfolios and, contacting clients every once in a while, clients find it frustrating. A lot of our clients that we work with, they act as their own financial advisor because they just don't see value in paying a financial advisor to manage their money for them. And so really coming to clients and bringing them value was what we were looking for. And what we found the way to bring value is through actively managing their portfolios and leveraging AI tools to be able to actively manage those portfolios. Because you can't have a dedicated one person focused 100% on one client's portfolio. That just doesn't work mathematically, right? But thanks to software and AI today, you can actually have an AI tool actively managing that client's portfolio within certain frameworks that you put together for that portfolio.
Well, when a client initially comes to you, what are they actually worried about? Not getting the right returns, or tax structure, or just general advice?
90% of our conversations with our clients start with, how do I pay less in taxes? That is very much the entry point conversation with almost all of our clients. And who are our clients? Generally speaking, our clients are first generation wealthy people. They're entrepreneurs, professional athletes, or entertainers. That's kind of our core audience that we talk to. And these people are generally, the first conversations, how do I pay less in taxes? I paid $1 million in taxes last year. I really wish I didn't have to do that, right? And so the conversation begins there. Once we start talking to them about how we can help them save money in taxes through various tax strategies, then the conversation becomes, okay, what do I do with that savings now? Right? And so then it starts getting into an investment discussion. We talk about how we can help them deliver outsized returns versus the market, better returns than what they're getting with their current situation. We have clients who, it's shocking the level of risk they get built into their portfolio, right? So you kind of have two extremes. You have the extreme where you've got somebody working with a traditional wealth management firm like a Goldman Sachs or a JP Morgan, and they have extremely low returns on their portfolios, 6 to 8%, like I said. You have other clients, they're getting great returns on their portfolios, but the risk level in their portfolio is insane. We use nitrogen to evaluate the risk ratings of our clients' portfolios. It used to be called Riskalyze. They changed the name to nitrogen for some reason, and it basically assigns a 0 to 100 scale of risk. We have clients that have risk ratings like 93 on their portfolios, and their upside and downside capture is insane, and so their portfolio values are just swinging up and down as the market goes up and down. And we help them get into new portfolios that have great increases in value over time, but at the same time, risk ratings are down in the 40s and 50s instead of up in the 80s and 90s.
So it sounds superb. Can you tell me then how the AI platform actually works? How does it connect to a client's account? Once it's connected, what's it doing day to day? I think you mentioned when we spoke before 4 strategies: preservation, defensive, balance, and growth. How does it all work?
Yeah, so the AI tool, essentially what we're doing is we're focusing on a limited universe, a curated universe of about 150 ETFs. For those who aren't familiar with the ETF world, there are more ETFs than there are stocks today, right? And that's because you can do an ETF about anything. An ETF is basically a way to make any type of investment liquid, whether that's a commodity like silver or uranium, or that's real estate or railroads, or you can make equities, and you can do an industry-based ETF like chips, for example, or international mid-cap companies is an ETF, right? So there's a number of ETFs. We look at a core group of about 150 ETFs. We're data-driven investment decision making, and so we're looking for ETFs that have a long history that we can use that data. And so the average age of an ETF that we're using is about 17 years old. We're not doing anything of these new crypto ETFs or these 5x leveraged NVIDIA ETFs, nothing like that. We're looking at very kind of structured ETFs that have a long history because we need that level of data in order to be able to do our analysis correctly. So it's a curated universe of ETFs that we're looking at. Depending on the strategy will invest in 10 to 15 ETFs at a time. And the idea is to create a non-correlated portfolio of assets. And so there's a very big focus on what we're doing on non-correlation. And so when we talk about that, what does that mean? Well, if you look at our defensive strategy, for example, if you looked at the 10 ETFs that we have in our defensive strategy, and you looked at them individually, you'd say, oh, okay, the risk rating on these should be about a 70. Through the non-correlation of assets, though, we're actually able to reduce that risk rating down to a 38. 30 is the risk rating for U.S. Treasuries. So one of the lowest risk investments in the world, U.S. Treasuries, has a 30 risk rating. Our defensive strategy has a 38 risk rating.
So
right?
amazing.
And the way we do that is through the non-correlation of these ETFs that we're investing in. And so the other key thing that we're doing is the core signal we're monitoring in order to make investment decisions is momentum. And for those without a lot of background in this, momentum is academically proven to be a great way to manage investments. And we talk about this from a physics perspective. Everybody knows an object in motion tends to stay in motion. The same is true with assets. An asset growing in value tends to continue growing in value until it doesn't, right? And as it starts declining in value, it tends to continue to decline in value. And so what we're looking for are assets that are just starting on that path of growth. We jump on board that train, we ride that train all the way up the hill, and then when it gets to the top of the hill and starts going down in value, then we jump off that train as quickly as possible, right? And so using momentum as the signal here, it is about capturing as much growth as we can, but it's also about avoiding the downside, right? So there's an old business school thing where the professor says, hey, if you invest in a stock for 30 days, you're going to get this return. If you invest in a stock for a month, but you avoid the 10 worst days, your return is going to be way up here, right? And so it's not just about capturing the positive returns, it's also about avoiding the negative returns. And that's a part of what we're doing with our non-correlation of assets. And then what we're doing here with the AI is the AI is able to monitor millions of data points at a time, all these transactions going on in the marketplace 24/7. And so it's able to keep a very close heartbeat on what's going on in the marketplace. And when something changes, it's able to jump out of that investment. Or for example, in our growth strategy, we use cash as a defensive mechanism. So if the market suddenly makes a massive downturn, it'll pull everything out into cash and wait until the market settles down for, wait a cycle or two and then reinvest everything again. right? And so the idea here is through this active management of the portfolio, we're able to keep clients in things that are growing and get them out of things that are not growing fairly quickly, right? And avoid those downsides. The other thing that's happening here that's important is how often do we rebalance these portfolios? So our preservation portfolio, like the name says, is a fairly conservative portfolio. And so it's kind of 10 relatively conservative ETFs. Frankly, mostly it's about 60% cash equivalents, maybe as much as 70% cash equivalents, and about 30-40% equities. But there tend to be fairly conservative equity investments there in the preservation portfolio. And because of that, it's kind of a fix it and forget it in a little way. So it will do a rebalance once about every 3 months, right? And so it will still keep a heartbeat on the marketplace, and so it'll make adjustments as needed. But generally speaking, it's doing a reevaluation of all the investments once every 3 months. Now, it doesn't mean it's going to dump everything and pick new things once every 3 months. It's making tweaks to it once every 3 months.
Is that irrespective of market moves and what's going on?
I'm sorry?
Is rebalancing every 3 months irrespective of what's going on in the marketplace?
It will definitely do a rebalance every 3 months, no matter what's happening in the marketplace. Now, that rebalance, the result may be it stays the same. Usually there's some slight tweaks, nothing significant. Sometimes there's very significant changes. So for example, following February 28th, several of our strategies went through significant rebalancing, right? So the preservation rebalances only once every 3 months. The defensive rebalances once every 3 weeks. The balanced strategy rebalances every 2 weeks. The growth strategy rebalances every 1 to 2 weeks. And so, we're seeing, because of everything going on in the marketplace since February 28th, when the war in Iran began, we've seen some significant adjustments. So for a while, we were the growth strategy, for example, was very heavy into uranium, very heavy into silver. It's pulled back out of those positions after everything going on with the war, because those, silver and uranium have stopped growing, right? And in a lot of ways, they've begun declining, right? Interestingly, the growth strategy has placed a fairly significant bet on, I mentioned, international mid-caps. There's an international mid-cap ETF that's been doing very well for the last few weeks since the war in Iran began. And so we've benefited from growth there. And so, if you look at our performance, right, the growth strategy is up, I think as the end of March, I want to say it's up 10 or 12%. I haven't actually seen today's numbers. But it's up on the year about 10 or 12%, whereas if you look at the market overall, the S&P 500, I think, is down 6% year to date. And so, we're significantly outperforming the market.
So when you get extreme volatility, like you've seen, when a war takes place, the system doesn't revert to cash. It actually moves out of the stocks or the ETF or ETFs that aren't performing and finds undervalued or other better performing assets.
It's a mix. So it may, in the moment, if there's a significant drop, so for example, COVID or some other event like that where there's a massive drop in the market, it may pull out into cash. But it's just going to wait a cycle or two and then reinvest everything, right? Now, of course, with the exception of our growth strategy, so if you look at the balance strategy, it keeps about 30% in cash and cash equivalents at all times. If you look at the defensive strategy, I want to say it's 40% in cash and cash equivalents, or 50%, excuse me. The preservation keeps like 60 to 70% in cash and cash equivalents at all times, right? So it really depends on the strategy, how much is kept in cash and cash equivalents. The growth strategy really just looks at cash as a defensive mechanism. When there's something going on in the market that the system doesn't understand yet, it'll pull out into cash, but then it'll go back and reinvest in those things that appear to be growing based on what the analysis of momentum says.
Okay, you also mentioned, I think, non-correlated assets. Can
Yes.
you explain to us a little bit what you meant by that?
Sure. So if you look at the parallel we like to draw is when you create an all-star basketball team, right? You don't just get all the best shooters. You want to get some players that are good at defense. You want to get some players that are good at passing. The same thing is true when you're putting together a portfolio. You want to get a mix of assets. So mix of asset types, So each of our models have certain allocation rules in terms of what percentage can go into cash and cash equivalents, what percentage can go into equities, what percentage can go into liquid alts, what percentage can go into commodities, right? And again, we're not investing directly into commodities, we're investing in ETFs that are based on commodities, right? So everything here is ETFs when I talk about the asset classes. The second thing is we have a certain risk target for each of these. So for example, for our preservation strategy, the risk target is 30. For our growth strategy, the risk target is 53. So we will never have a risk rating, a total risk rating higher than 53 on the growth strategy. Sometimes it may be a little lower, but it'll never be higher than 53. And then we look at allocating the investments. And so the growth strategy looks at usually 15 ETFs at a time, and it'll invest in 15 ETFs such that the combined risk rating due to non-correlation will be down at a 53. So even though individual ETFs may have a higher risk rating, may have a 70 or even higher, because of the non-correlation of those assets, because they don't move in the same direction at the same time. So you may have one asset that's growing, another asset that's declining, another asset that's moving sideways, right, or not moving at all, right? The whole point here is that the growth of one does not impact the others, right? And so we look for that kind of non-correlation of assets. And I'll give you another example here, right? Silver and gold used to be very non-correlated assets. And so for a while, these models invested both in silver and in gold because they were non-correlated. What we've seen over the last 18 months is those assets have become more and more correlated with one another. And so the models have very often dropped one or the other and just focused on one of them because there's no value to being in both anymore because they're so correlated with each other.
Excellent. So if we talk about performance, if I came to you with 20 million tomorrow, what are my options and what returns are you showing?
Yeah, so the returns that we're showing on, if you take our preservation strategy, for example, right, it's got a 30 risk rating, we're generally projecting a 7.8% annualized return. And that is a average over 10-year horizon. So sometimes it can be a little higher, sometimes it's going to be a little lower. We're not guaranteeing anything, right? But it's averaging at about 7.8%. Now,
that's a defensive play.
That is the wealth preservation play. So it's the most conservative play, right? So, but that being said, last year it returned 13%. Okay, so some years it's going to be higher, significantly higher. Our defensive strategy has got a risk rating of about 38, so just slightly higher. It's returning on average 19%. Our balanced strategy has got a risk rating of 46. It's returning on average 25%. Our growth strategy has got a risk rating of 53. It's averaging 36.5% returns, right? Now, last year was a particularly good year for all of these strategies. Growth returned 44% last year, right? This year we're doing pretty well, right? In January, the growth strategy was up 18%. The market was up just slightly. In February, the market was down overall. The growth strategy still grew another 4%. In March, the market was down significantly. The growth strategy was down slightly. Okay, so we're not showing positive returns every month, but we're ending up, the average returns on an annualized basis are coming out pretty strong with each of these strategies.
It's amazing. If a client comes to you, then do you advise them on what strategies they should go into, depending on obviously, the information they provide you, or do you let them choose themselves?
So we have a licensed financial advisor on our team who can help the client figure out what they should be choosing. Generally speaking, the way the conversation runs is we have conversations with clients around, okay, you've kind of got three core pieces of your portfolio, right? You've got your rainy day fund, you've got the cash flow generation that you're looking for, and you've got asset appreciation, right? And so we kind of help the client to figure out how to break up his portfolio into those kind of strategies and then figure out what's the right mix of investments to go in there, right? Generally speaking, we have two types of clients. We have clients who come to us that have their own financial advisor already, and that financial advisor will help them figure out which of these strategies to get into, what percentage of their portfolio to put into them. We have other clients that'll come in and say, I want to put this percentage of my portfolio, I want to put 10% into defensive. That's my rainy day fund. I want to put the rest into a mix of balanced and growth, right? Now, I will say we do have a couple of other investment options that we provide to our clients. If the client is an accredited investor, then they also get access. We have a debt fund that we offer that's returning 18% a year, pretty much a consistent 1.5% per month annualized there. We also have what we call the high growth strategy, which is a mix of the growth and the debt fund. So you invest your assets into the growth fund. We take a 50% margin loan on that and put that 50% margin loan money into the debt fund. It's generating that 1.5% return per month. We're reinvesting that cash back into the growth fund. And so it's a virtuous cycle that feeds on itself. And so it returns even better returns than the growth strategy does by itself, right? So it's the high growth strategy. So that being said, in retirement accounts in the US, you're not allowed to do any margin. Generally speaking, our clients tend to be a little more aggressive with their retirement money. And so what we've seen is most clients in their retirement accounts will tend to focus heavily on the growth model because that's the highest growth you can get. In their regular brokerage accounts, they'll kind of do a mix depending on what they're looking to do, right? They want to keep a rainy day fund. They want to have an aggressive strategy, but they're not really sure. And so what we've seen is clients will start off and they'll come in and they'll say, okay, I'm going to put 20% into defensive and I'm going to put 40% into balanced and 40% into growth. And over time, as they start seeing the returns, they start saying, I can get by with 10% in defensive and I could put a little more into growth, right? Or our clients tend to start getting a little more aggressive over time is what we've seen. They tend to balance more towards more aggressiveness. We haven't really had many clients that have come in and said, I'm not happy getting, 44% returns that they got last year, and therefore they want to decrease their investment in that, right? So it really depends on the clients, but we try to leave as much of that decision making on the balance of the portfolio up to the client. Very often they'll come to us and say, hey, can you do a portfolio analysis for me? What if I did this? And we'll put together, okay, what would their overall portfolio risk rating be? What would their expected average returns, annualized returns be based on that mix? And a lot of times our clients will come in and say, okay, my wealth target is this, right? So let's say today they've got $10, $12 million and say, my goal is to get to $20 million in portfolio value. And we'll say, okay, here's 3 different mixes you could do, and here's how many years it should take you to get to that wealth target of 20 years. Right. And they kind of make the decision based on that about, okay, well, I was planning to retire in 5 years and I wanted to retire at $20 million. So if I can get there in 5 years with this mix, I'll go with that mix. Right. That's kind of the way the conversations usually run.
I mean, if you showed a business and made 44% return, you should be able to borrow any amount of money to actually just put in it.
Yeah. So
I think I'd be borrowing left, right, and centre just to invest.
As we tell all of our clients, right? Past performance is not a guarantee of future performance.
Of course.
Right. There's no guarantees, and there's always risks with every investment. I don't want to make this sound like this is a zero risk thing and all of that, right? As well as I do, there's always risks in every investment strategy. What we've seen, though, is that the performance of these models has been very good, which is really, one of the main reasons why I'm personally investing my money through these models, and why we see our clients investing in these models is because, and why we're comfortable presenting these models to our clients is because they do seem to be working, right? And even when the market shows extreme events, they still seem to be performing, right? I mean, you look at the way the market's going today. I mean, it's just up and down every day, depending what's going on with the war, right? And knock on wood, somehow these models seem to keep chugging along and delivering the performance that our clients are looking for.
That's excellent, because the market now is run on sentiment. It's run on people's comments, and they change every 10 minutes. So the fact that your model is operating efficiently with all that, I think, is quite astounding. Tell me, we talked about this when we first met. Why not a hedge fund?
I'll tell you that there's really 2 reasons here for that. I personally dislike hedge funds because I don't like the idea that they're taking 20 or 30% of my profits. I don't like the idea of carry, right? For when I'm doing my own personal investments. I also don't like the fact that what you often see with hedge funds is they say, our management fee is going to be 2%, it's going to be 2 and 20. And then all of a sudden all these administrative fees start showing up as well. Right. And so I just really don't like that hedge fund management model. Now, will we begin offering these as funds potentially down the road? We may. right? Because what we've discovered is there are investors who would rather invest in a fund than have us connect our AI software to their account at Schwab, for example, and manage their investments automatically there, right? So we may begin offering these as funds, but the model that we do today is really a pure kind of asset management model where it's a 2% management fee. No carry. We do zero carry. And so often we'll have clients who say, oh my gosh, nobody does those kinds of returns. Well, the truth is, if you look at a lot of hedge funds, they are doing these kinds of returns. They're just keeping a lot of the profits for themselves, and so the investor doesn't see these returns. These are very similar strategies to what hedge funds are running. We're just doing it where we're sharing all of the profits with the client. We're giving the client all of their profits. We're not keeping any of the client's profits. We just have this flat 2% management fee.
Do you have these audited the same way as a hedge fund? Like they get an NAV? Do you get an NAV for these models, or how are they actually audited for returns?
So we're actually going through and having everything audited right now as we speak. So we expect in the next, I think it's about 6 weeks, we're going to have audited returns for the last few years to show to clients for these. We really haven't begun offering these to the public effectively until the last month to 6 weeks. Prior to that, it was very much kind of a very tight-knit kind of friends and family only, right? So we today have over $200 million being managed through these strategies. Okay, so it's not a small amount of money, but it's not billions, right? But at the same time, we've begun onboarding our family office clients into these really only during the month of March is when we've had our first clients onboarding into these. Today's April 1st, right? So we've only had clients onboarding during the month of March so far from our family office clients that we've been managing. Before that, it was very much just a tight-knit group of people that believed in these models and wanted to put them to the test. And so there's a little over $200 million being managed today through these models.
Do you think this model will put pressure on traditional hedge funds?
Oh, I sure hope so. Honestly, I don't see any reason why these models and this approach couldn't grow to be a competitor to hedge funds. I also see this as being a potential great model for retail investors. So, the big explosion that's happened, from COVID forward has been the growth in the retail investment space with Robinhood and E-Trade and these types of things. And there's a lot of people that got into investing during COVID because they had time, and now they're working again and they don't have time to be actively managing their portfolios the way they used to, right? And they still want to be invested because they understand how they can make money there. And so I see our AI software as a way to enable them to have their portfolios actively managed, not have to deal with your traditional financial advisor, right? Have their portfolio actively managed on a day-to-day basis and have them be able to generate income from that, right? And enjoy that experience. I also think there's a lot of people who wanted to do Robinhood, but have never been able or willing to invest the time to learn about different stocks and that sort of thing. They just, they want to be invested in the market. At least in the US, what I see is the vast, vast majority of people today, no matter what their age group, no matter what their income level, they would like to be invested in the market because they see this as a way to make money on money, right? And it's just a question of how do they get in the door. And so I really see these tools as being something that can be leveraged by even your average retail investor. Now, I think this is a great thing for family offices. I think this is a great thing for RIAs to look at for their clients. But I also think this is a great thing for even the retail investors to look at.
Talk us through the pricing. I mean, this is essentially a SaaS, $99 bucks a month. That opens up this massively. So, I mean, the target market, apart from family offices, you say could be retail, high net worth, RIAs. Could this be distributed through other firms, broker dealers, advisors? How scalable is this in your mind?
In my mind, this is scalable, basically to infinity. There's no reason it couldn't scale because what happens is when they put their money into these different models, right? The models do block trading. And the trading is driven by AI. And so there's nothing inhibiting the ability of the trades to happen no matter how many investors get in here, right? So the way we're setting it up today is we have our family office clients that we're dealing with on a one-to-one basis, right? We are intending within the next 30 days to launch this actually as a SaaS service. And the website's going to be darmanai.com. The website is being built as we speak, quite literally. I had a call just before this one with our website builders reviewing the status on things. And so we're planning to launch that within the next 30 days where people can come and sign up. And it'll be very similar to a Robinhood service, right? You onboard, you set up your account, and then you kind of allocate what percentage of that account you want to have go into the different strategies. And then the AI tool will start managing your investments for you, right? And that SaaS service is going to be offered at essentially $99 a month or $999 a year to manage that. And so I don't see any reason this can't scale dramatically, right? To literally, we've already today, that $200 million today is already made up of several thousand investors.
That's amazing.
I don't see any reason this couldn't just grow phenomenally, right?
So really, this is a global product.
Absolutely. So, we're able to manage money. We primarily in the U.S. focus on managing money through Schwab custody accounts, although we do have one-off clients where we're doing things in Fidelity and other custody holders. For international accounts, though, we're looking at Interactive Brokers, and so we have one client who's got accounts around the world because he has businesses around the world, and we're actually, for his businesses, we're going to be doing treasury management for him, investing the money he's got sitting in his treasury. So he's got a Singapore bank account, he's got a UAE bank account, he's got a Euro bank account. We're setting up through Interactive Broker investment accounts, custody accounts for each of those businesses.
That's amazing.
Completely an international product. So yeah, and we have clients we're looking at in the Bahamas and Jamaica, as far afield as Kazakhstan and Eastern Europe. Right?
What marketing are you doing at the moment? What marketing are you doing at the moment?
What marketing are we doing at the moment? Word of mouth. We are only doing word of mouth marketing. We have not promoted this. We've not done, email marketing or dialing for dollars or any of that, right? We're looking at how we do that, particularly once we get the Darman AI platform set up as a SaaS service. We'll start doing a lot more one-to-many marketing. And so we're going to be working on that. But, I'd say doing this podcast with you, Gary, is the most marketing we've done.
That's amazing. One other question I've got. Will this service be accessible on your mobile via an app?
That is the intention. Yes. So we are developing an app version. So the website will come out first, and then the intention is to develop an app version, similar to your Robinhood or E-Trade app or your JP Morgan app or whatever, where you'll be able to go in and do everything within the app.
This is what you call what you're being is a disruptor. You're disrupting the industry. So tell me, what do you think the change will be with systems like this and market opportunities like this over the next 5 or 10 years? How do you see the industry reshaping? Because it will have to reshape as people become more aggressive in this type of approach.
Yeah, I think everyone in the industry today, whether that's Goldman or JP Morgan or John Smith RIA down the street, everyone is looking at how can they leverage AI to help people manage their investing, right? And there are a lot of startups out there, frankly, that are really attacking this space. And the approach most people are taking is, let me provide you with a AI tool that essentially replaces the financial advisor. Let me provide you with an AI tool that will act as your assistant in helping you more effectively invest through Robinhood. So even Robinhood is developing their own AI advisor tool, right? They're looking for things that will help answer questions for clients, help clients develop strategies, that sort of thing. The funny thing is, if you go to Anthropic or you go to ChatGPT or you go to any of these AI tools today, they will actually very clearly tell you, don't let me manage your portfolio, because they recognize they're not ready for prime time in portfolio management. The approach that we're taking is a little bit different. We're not trying to give clients advice on which stocks to pick or that sort of thing. We've developed an AI tool which is focused on a very curated set of ETFs and doing a portfolio approach within that curated set of and different models, right? So you can invest in these different models, right? And you can choose to invest in those models, and it's kind of, let those models run. and forget it, right? And let us just manage all the rebalancing through our AI tool. We don't want to sit there and replace the financial advisor with an AI tool. I personally think that if a financial advisor is good, he's bringing value to his clients. He's helping them plan for their kids' college education. He's helping them plan for retirement. He's helping them figure out how to buy their home, how to buy the next home, those sorts of things, right? I really believe financial advisors can bring a lot of value to clients. I mean, my mother was a financial advisor for 40 years. Okay, so I know exactly what a good financial advisor should be doing with their clients, right? What I dislike in the industry, where I think we're going to see a massive amount of disruption, is the financial advisors that aren't bringing that value to their clients. The financial advisors that are just, and we have a lot of athletes, particularly professional football players that are our clients, who they got into the league, they got a financial advisor, the financial advisor put their money into mutual funds or into a couple of ETFs, and is charging them 1.5%, and they basically never talk to the athlete. The athlete never gets any education on what's going on with his investments, and frankly, his investments are usually growing at a much lower rate than what the market is, right? And so those financial advisors are not bringing their clients any value. And that's a big issue in professional sports today. And so I really see those types of financial advisors as being a thing of the past. They are going to be disrupted by these types of AI tools, right? It's really going to be on the financial advisor to prove the value he's bringing to his client, or they will become a thing of the past.
Yeah, I agree with you. I totally agree. I've spoken to quite a few people that were trying to do something like what you're doing, but they just didn't have the tool that you've got. I mean, the difference is your tools. A lot of them want to back it into other people, other wealth advisors, but no one has got this tool, and that's what separates you from the rest. If you could change one thing in wealth management overnight, what would it be?
I won't claim to be such an expert in wealth management that I'm going to say I know how to change the industry overnight, right? I wouldn't when I answer the question you've just asked. I do think, though, that the changes that are happening from a technology perspective are going to force the industry to really prove the value that it's bringing to its clients. And I think that's really the big change that we're going to see. And is that going to happen overnight? Is that going to happen over a number of years? What I see, if you look at the accounting space in the US, CPAs, generally speaking, have no retirement plan. I mean, quite literally, I know of a number of CPAs that are dying at their desk, right? They're working well into their 70s, doing people's taxes, because they've got no exit strategy how to hand the company on to somebody, because there's actually a much smaller number of CPAs coming out of college today than there need to be in the US. And so you have there's this issue in the accounting industry right now. I look at the financial advisor industry and I wonder if it's going to head in that same direction, right? Financial advisors are continuing to work until they're older and older and older, and they're going to continue doing that because they don't have somebody to hand it off to, because maybe there's not as many financial advisors coming in. And also, I think a lot of financial advisors are going to recognize, hey, this is a lot harder work than it used to be. I've actually got to provide value to my clients now because I can get replaced by an AI tool tomorrow, right? And so I think that we're going to see something similar to what's happening in the accounting industry in the US today. Probably is going to happen in the financial advisor industry, as we see financial advisors get the pressure put on them to deliver value, and some are just not going to be up to the task.
I think you hit the nail on the head. AI will be a tool that helps a lot of people, but it's also going to replace basic untalented people. That is the long and short of it. Okay, I really enjoyed this, David. I hope you did enjoy being a guest. I'd like you to could you just tell everybody where they can find you? I know you mentioned your website earlier, but if you're on LinkedIn or any other platforms where they can get a hold of you, or a telephone number or an email address, anything where they can find you.
The best way to reach us is darmangroup.com or info@darmangroup.com. If you go to darmangroup.com, there's a link you can push to enter in some information and reach out to us, and we'll follow back up with you. A contact us link. But darmangroup.com, that's DARMEN group.com, is the best way.
Thanks very much. Thanks for being on. Guys, I'd like to thank you for attending and watching another podcast of Wise Tech for Wise Money. We'll be back in the next couple of days with another episode. Thanks very much for listening in, David. Thank you very much for being a guest today.
Thank you very much for having me, Gary. I appreciate it.
You're welcome. It's been very, very enjoyable.